20 investment tips to make you rich. Welcome back to Financial Freedom Framework. Today, we're diving into the world of wealth building and exploring 20 investment tips that will make you rich. So, let's get started. Tip number 1. Start early and be consistent. Let's consider two individuals, Alex and Ben. Alex starts investing $5,000 annually at age 25 and continues until age 65, while Ben starts investing the same amount at age 35 and continues until age 65. Assuming an average annual return of 7%, Alex's investments would grow to approximately $1.22 million by age 65. On the other hand, Ben's investments would only reach around $570,000. Starting early and being consistent can make a substantial difference in your wealth accumulation over time. Tip number 2. Diversify your portfolio. During a market downturn, diversification helps reduce risk. Suppose you have a portfolio with 60% stocks and 40% bonds. In a year when stocks plummet 20%, the bond portion might rise 5%. As a result, your overall portfolio losses would be minimized to around 10%. Diversification across various asset classes can help cushion the impact of market fluctuations. Tip number 3. Understand your risk tolerance. Consider two investors, Sarah and Mike. Sarah is risk-averse and prefers stability, while Mike is more willing to take risks for higher potential returns. Sarah allocates her investments with 70% in bonds and 30% in stocks, while Mike goes for a riskier allocation with 70% in stocks and 30% in bonds. During a market downturn, Sarah's portfolio may experience smaller losses due to its higher bond allocation, aligning with her risk tolerance. Tip number 4. Educate yourself. By staying informed about market trends, economic indicators, and investment strategies, you can make well-informed decisions. Researching historical data on different assets and studying past market cycles can give you valuable insights into potential investment opportunities. Tip number 5. Invest in what you understand. Suppose you're interested in technology and believe in the future of renewable energy. Investing in tech companies or renewable energy ETFs allows you to align your investments with your interests and knowledge. Your understanding of the industry can help you evaluate the potential risks and rewards more effectively. Tip number 6. Avoid emotional decisions. During a market downturn, fear may drive investors to sell their investments at a loss to avoid further decline. However, this emotional decision can lock in losses. By sticking to a long-term investment plan and avoiding reactionary moves, you give your investments a chance to recover and potentially thrive in the future. Tip number 7. Keep an eye on expenses. Let's compare two mutual funds with similar holdings and returns. Fund A has an expense ratio of 0.5%, while Fund B has an expense ratio of 1.5%. Over 30 years, assuming a 7% annual return, Fund A would accumulate approximately $1.3 million, while Fund B would accumulate around $1.1 million due to the higher fees eating into returns. Tip number 8. Rebalance your portfolio. Suppose you have a target asset allocation of 60% stocks and 40% bonds. After a year of strong stock market performance, your portfolio may shift to 70% stocks and 30% bonds. To maintain the desired allocation, you would need to sell some stocks and buy more bonds. Rebalancing helps you stick to your long-term investment strategy and manage risk effectively. Tip number 9. Don't time the market. Trying to time the market involves predicting when it will go up or down. Studies show that even professional investors struggle to consistently time the market accurately. For instance, if an investor missed the best 10 days of the S&P 500's performance from 2000 to 2020, their overall returns would have dropped significantly, turning a positive return into a negative one. Tip number 10. Invest for the long term. Long-term investments tend to outperform short-term strategies. According to historical data, the S&P 500 has generated positive returns in about 75% of all 10-year periods since 1926. Staying invested for the long term allows you to ride out market volatility and capture the market's growth potential. Tip number 11. Take advantage of employer matches. Imagine your employer offers a 50% match on your 401k contributions up to 6% of your salary. If your annual salary is $60,000 and you contribute 6%, your employer would add $1,800 to your 401k. That's essentially free money and an immediate 50% return on your investment. Tip number 12. Pay down high-interest debts. Consider two individuals, Rachel and James, who each have $10,000 in credit card debt with an 18% interest rate. Rachel decides to pay only the minimum monthly payment of $200, while James aggressively pays $500 per month. Rachel would take around 94 months, nearly 8 years, to pay off the debt with over $9,800 in interest, while James would clear his debt in just over 2 years with approximately $1,300 in interest. Tip number 13. Reinvest dividends and interest. Let's assume you invest $10,000 in a dividend-paying stock with a 3% yield and reinvest the dividends. Over 20 years, your initial investment would grow to about $18,000, assuming the stock price remains unchanged. If you didn't reinvest the dividends, your investment would only be around $13,000. Tip number 14. Stay updated on tax strategies. Understanding tax-efficient investment strategies can significantly impact your after-tax returns. Utilizing tax-advantaged accounts like IRAs and 401ks can help defer taxes on investment gains, leaving you with more money to compound over time. Tip number 15. Avoid herd mentality. During a market bubble, many investors may follow the crowd and invest heavily in a particular sector or asset class. However, this herd mentality can lead to inflated asset prices and potential losses when the bubble bursts. Conducting thorough research and making independent decisions can protect you from following the crowd into speculative investments. Tip number 16. Have an emergency fund. Imagine you have a well-funded emergency fund equivalent to 3 months' worth of living expenses. During a financial crisis or unexpected event, you have a safety net to cover essential expenses without tapping into your investments. This keeps your long-term investment strategy intact. Tip number 17. Monitor your progress. Regularly review your investment portfolio's performance and compare it to your financial goals. For instance, if your target is to retire with $1 million in 25 years and you're currently on track to reach $800,000, you may consider adjusting your investment contributions or strategy to bridge the gap. Tip number 18. Seek professional advice if needed. If you're uncertain about investing or have complex financial goals, seeking advice from a qualified financial advisor can provide valuable insights tailored to your situation. An advisor can help optimize your portfolio, manage risks, and provide guidance during challenging economic conditions. Tip number 19. Learn from your mistakes. Perhaps you invested in a company that experienced a significant decline due to poor management decisions. Instead of panicking, reflect on the experience and identify what went wrong. Learning from your mistakes can lead to more informed investment decisions in the future. Tip number 20. Stay disciplined. Consider an investor named John who diligently contributes $300 per month to a retirement account for 30 years, earning an average annual return of 8%. By staying disciplined and consistent, John's contributions would grow to approximately $405,000. However, if John occasionally skipped contributions due to market fluctuations or other reasons, his total investment would decrease significantly. And there you have it, the 20 investment tips to make you rich. By incorporating these 20 investment tips into your financial strategy, you're equipped with a solid foundation to navigate the markets and work towards building substantial wealth. Remember, investing is a journey that requires patience, discipline, and continuous learning. Start implementing these tips today, and as you gain experience and confidence, your financial future will shine brighter than ever before. If you found this video helpful, don't forget to like, subscribe, and share it with others. Thank you for joining us, and until next time, happy investing.